Welcome back to your ultimate NISM exam prep guide. We are jumping right back in, seamlessly continuing into Part 2 of Chapter 2. In the first part of this explainer, we laid down the foundational bricks of the securities market. But today we are going to break down the exact post-trade reality. I mean, what literally happens the second after you click buy on your screen? Get ready because we're about to dive deep into the absolute plumbing of the financial ecosystem.
Here is our roadmap for today's explainer. We're running through trade settlement and risk, market intermediaries, investors, the big world of forwards, futures, and options, market strategies and swaps, and finally, DMAT and a quick revision. All right, let's get into Section 1, Trade Settlement and Risk. This is the post-trade reality. To really grasp this, you just need to think of the stock market like a highly regulated, bustling marketplace. The post-trade process is essentially split into two distinct steps: clearing and settlement. Think of clearing as the giant calculator phase. It computes exactly who owes what to whom at the end of the day. Settlement, on the other hand, is the action phase. That's the actual, physical, digital exchange where the seller finally hands over the shares and the buyer hands over the cash. Now here is where it gets really interesting, and you definitely want to note this down for the exam. It's a concept called novation. Think about it. When you buy a stock on the exchange, you have absolutely no idea who is on the other side selling it to you. So what if they just vanish? Well, through novation, the clearing corporation steps right in as a guaranteed middleman. It literally becomes the buyer to every single seller and the seller to every single buyer. This is a brilliant system because it drops counterparty risk to virtually zero. You never ever have to worry about the guy on the other side defaulting. But, of course, there is a catch. Because the clearing corporation is taking on this massive, unbelievable amount of risk for millions of daily trades, it has to protect itself, right? It does this by charging specific margins. First up, the initial or upfront margin. This makes sure you have enough skin in the game before you're even allowed to trade, and it's based on a value-at-risk philosophy. Then you have the peak margin, which is collected intraday just to cover any sudden wild spikes in risk. And finally, the mark-to-market or the MTM margin, which covers any notional losses if the price starts moving against you during the trading day.
Let's pause and think about this for a second. What happens if a buyer suddenly defaults out of nowhere? Who takes the financial hit? Well, as we just learned, the answer is the clearing corporation. They are the ultimate guarantor of your trade, which is exactly why those margin requirements we just talked about are so strictly enforced. No margin, no trade. Okay, moving on to Section 2, Market Intermediaries. Let's meet the key players in this ecosystem.
So who actually runs this machine? It's a whole network of registered entities that form the critical plumbing of the financial system. You've got the stock exchanges, which match orders anonymously. You have depositories and their participants acting like massive digital vaults holding your electronic shares securely. Trading members are the ones who actually facilitate your orders. Custodians do the vault job, but for massive institutions. Clearing banks are the ones moving the actual money around. Merchant bankers, they are the architects building new IPOs from the ground up. And underwriters step in as an insurance policy for those IPOs, committing to buy up any unsold shares. Every single entity here plays a highly specialized, absolutely vital role.
Now, let's step completely outside the stock market for a moment and look at agricultural commodities. In this space, farmer-producer organizations, or FPOs, are total game changers. FPOs basically help small farmers team up. By pooling their resources, these farmers can suddenly negotiate way better prices, access modern farming tech, and entirely bypass those predatory middlemen. It's an incredibly smart strategy for transforming rural supply chains and bringing everyday farmers right into the organized markets. And when those farmers or commodity traders need to physically store their goods, they rely on two critical players. Warehouse service providers, or WSPs, supply the actual physical infrastructure. Think giant silos or cold storage. They also issue something called negotiable warehouse receipts, which you can actually take to a bank to get a loan. But wait, how does the bank know the wheat in that silo is actually good quality? That is exactly where quality assayers come in. They are essentially independent scientists who test the moisture, purity, and standard of the goods, officially certifying that a grade A product is genuinely grade A. Next up, Section 3, Investors. Let's look at the institutional heavyweights versus the retail crowd. First up, the institutional whales. Make no mistake, these are the guys who really move the markets. Foreign portfolio investors bring in huge waves of global capital. Mutual funds pool small amounts of money from millions of everyday people. Insurance companies and pension funds, they are managing massive, long-term pools of capital just to secure people's retirements.
Venture capital and private equity are out there funding early-stage startups and orchestrating corporate buyouts. Hedge funds are out hunting for aggressive, absolute returns across global assets. And family offices manage the immense generational wealth of ultra-rich families. Together, they are the undisputed heavyweights of the ecosystem.
Now take a mental screenshot of this because it is extremely high yield for your exam. Alternative investment funds, or AIFs, are strictly separated into 3 categories by the regulator. Category 1 focuses on socially or economically desirable areas. Think startups and infrastructure. Category 2 is for things like real estate and private equity. Now notice this, neither Category 1 nor 2 can borrow money to amplify their trading. But Category 3, which includes hedge funds, is totally allowed to use leverage and complex derivative strategies. Memorize that key distinction.
Then, apart from the massive institutions, we have retail investors. That's individuals building personal wealth, ranging from beginners opening their first account to ultra-high net worth individuals. But we also have corporates. Now, you might wonder, why would a manufacturer or an importer actively trade in these financial markets? Well, it's not to speculate. They do it to protect their actual business margins. If you manufacture chocolate, you are going to use the commodities market to lock in the price of cocoa today, just so a sudden price spike next month doesn't completely wipe out your profit margin.
Moving to Section 4, Forwards, Futures, and Options. Let's open the playbook on transaction types.
Before we get into complex derivatives, you need to know that regular trades don't just magically settle the instant you click buy. They follow a very strict timeline. T+0 means the trade settles on the exact same day, which you often see in Forex markets. T+1, often called TOM or tomorrow trades, settle the very next business day. Historically, equities were T+2 spot trades, settling 2 full days later, though Indian markets have been rapidly and very successfully shifting toward the lightning-fast T+1 cycle. All right, let's talk derivatives. The single most foundational concept you need to grasp here is the difference between forwards and futures. A forward contract is really just a private handshake. It's over-the-counter, meaning it's completely customized between 2 parties, but it carries incredibly high counterparty risk. If one guy just decides to walk away, you are in major trouble. Futures, however, are exchange-traded, heavily standardized contracts. And because they go through that clearing corporation we talked about earlier, zero counterparty risk.
And that brings us to options, which are brilliant because they give you the right but absolutely not the obligation to buy or sell. Think of it like putting down a non-refundable token advance for a piece of real estate. Let's look at this example. Arvind pays Salim a 100 rupee premium for a call option to buy the Nifty index at 11,000. If the market surges to 11,200, Arvind is thrilled. He exercises his right to buy at the cheaper price and makes a profit. But if the market crashes down to 10,800, Arvind has zero obligation to buy a losing asset. He simply walks away. He loses his initial 100 rupee premium, and Salim gets to keep that premium.
Which leads us perfectly into Section 5, Market Strategies and Swaps. How do people actually use these instruments?
You've got to keep these definitions clear for your exam. Traders are usually looking at short-term technical price patterns. Speculators completely embrace high risk based on a specific view or info they have about the future, hoping for a massive payout. Hedgers are the exact opposite. They run from risk, using contracts to build a protective wall around assets they already own. Arbitrageurs are basically hunting for risk-free pricing errors. They'll buy an asset cheap in one market and instantly sell it for slightly more in another market. And pledging? That's simply using your digital shares as collateral to take out a cash loan, exactly like you would pledge gold.
And then we have swaps. Swaps are incredibly clever financial tools. Imagine a corporate borrower who took out a massive loan with a risky floating interest rate, but now they're terrified that interest rates are about to shoot up. What do? They can enter an interest rate swap to exchange their unpredictable floating rate cash flow for totally predictable fixed rate cash flow with another party. It's a hugely popular way for massive institutions to manage interest rate and currency risks.
Finally, Section 6, DMAT and Revision. We're opening up the digital vault.
So where do all these securities actually live? They exist in a purely digital form, all thanks to dematerialization, or DMAT. This is the process that permanently converted old, easily damaged physical paper share certificates into electronic balances. Honestly, it is exactly like converting the physical cash in your physical wallet into a digital UPI balance on your smartphone. It makes trading incredibly fast, perfectly trackable, and infinitely more secure. Rematerialization is just the reverse, turning digital shares back into physical paper, though, as you can imagine, almost nobody does that today.
And just like that, we've reached the end of Chapter 2. We've completely unpacked the post-trade ecosystem today, from clearing corporations guaranteeing trades to option strategies and DMAT accounts. The market isn't just some random casino, it is a meticulously structured, highly regulated machine. Keep revising these core ecosystem concepts and you are going to absolutely crush your NSM exam. But I want to leave you with one final thought before your next real-world trade. Now that you know exactly who is working behind the scenes to guarantee your money, how will that change your personal appetite for risk? Think about it. I'll see you in the next explainer.
We are